afternoon and welcome to KPMG's Africa Conversation series. I'm Alicia Seckham, and as usual, we're broadcasting live from KPMG's headquarters in Johannesburg this afternoon. Well, Africa is no longer just a curiosity. It's a big source of profit, boasting GDP growth of more than 5% over the past decade, a population of over 800 million, and a total purchasing power of 1.9 trillion US dollars. So with the growth of any financial services sector really intertwined with that of any economy, it's not hard, I guess, to see the kind of appeal that this sector and investing in it puts on the table. Once this investment gets made, it really then triggers a vicious circle where financial services plays a critical role in unlocking Africa's full potential. This afternoon, we've got Junior Ngulube, who's Chief Executive Officer of Munich Re Africa, BC Lamikandra, who's the Head of Management Consulting at KPMG Nigeria, Nicholas Young, who's Chief Operations Officer for Africa at Citibank, and Dave Cook, who's Director of Actis, all joining us to take a closer look at the growth of the financial services sector on the continent, the kind of opportunity it offers investors right now, and the role it plays in growing Africa as well. Of course, as usual, we'd like to keep this session as interactive as possible, so we'll be fielding questions from our live audience right here in studio with us this afternoon, as well as from our international audiences that join us from across the globe, of course, and that via webcast. They'll be getting the opportunity, of course, to be posing their questions to our esteemed panel this afternoon. For now, though, let's get straight into some conversation. Thank you all for joining us this afternoon. And Dave, let's perhaps start off with you. I mean, undoubtedly, we're looking at a changing shape of African economic markets, and at the risk of sounding too simplistic, grouping African economies all under one umbrella, what for you are the most prominent themes that emerge when we look at the African economy right now?
Alicia, I think I'd group that into two broad themes. The first is the fundamental driver of consumer spend that's going on in our markets. The increasing disposable income as after a decade of successful growth across a lot of the continent is really driving an underpin of spend in these economies. And the second big theme is what's going on in government infrastructure spend, government and private sector infrastructure spend. So against those two themes, as a private equity investor in the continent, you could pin almost all of our investments on the back of one or two of those big themes.
Absolutely. Well, Junior, I mean, coming into this territory, part of the business logic is that Africa domestically boasts this emerging middle class that's rising pretty quickly, and beyond its borders, it's also growing trade links with other emerging markets that are growing just as extensively. So that ultimately raising the strategic importance of financial services as a sector on the continent itself, the mere demand for formalized financial institutions, right?
Yeah, you're absolutely right. It's the financial services. I come from the insurance side, insurance and reinsurance, if I must say. I would say we have historically oiled the wheels of commerce as insurance and reinsurance companies in terms of providing risk services. And what we're seeing happening now with economic growth and disposable incomes going up, we see people coming into the financial services market. They're buying assets. They are buying their first homes, some of them, their first cars, some of them, and they need to protect these assets. That's a growing market for us as insurance companies. And the insurance penetration in this market is increasing as a result.
Absolutely.
And we also heard about infrastructure. That is going to open up intra-Africa trade more importantly than previously, where we had international trade being serviced by our infrastructure. It now needs to be in support of intra-Africa trade. And again, as insurers and reinsurers, we play a very important role in providing insurance coverage for these infrastructure projects as they get rolled out.
Absolutely. We'll be getting into some of the detail of that and exactly what kind of role you play, in this regard. Nicholas, so from the perspective of a player that's involved in the financial landscape on the continent, the appeal for Citibank as it stands right now?
Well, I think it touches a number of different areas. David mentioned the increasing consumer spending power, which I think plays out in the consumer market. But if one throws into that the overlay of increasing urbanization, Africa is starting to grow much faster with a lot of big cities. I think we've got about 7 cities greater than 15 cities greater than 1 million people, and about 7 cities with 7 odd million people living in them. That is becoming a big issue as well. The rate of digitization in terms of people just transacting, using mobile phones for mobile payments. If one looks at the success story of M-Pesa in East Africa, fundamentally changing the way people are doing business. And I think, again, the increasing wealth and affluence and consumption that people have, and that is starting to drive different behaviors. People can afford more, and they can also save more. Now that, in terms of coming up to capital formation, that then becomes really interesting at a corporate bank perspective, because that is a critical next step for us. I think the theme around investment in infrastructure is key. The natural resources play as well is absolutely fundamental to what is going on in Africa. I think particularly where oil prices have gone over the last few years, your big oil producing countries have massive foreign exchange balances available. And even a lot of the countries that have maybe not oil but other natural resources, they're starting to have a much more healthy financial position. So when you overlay all of that, plus the increased focus and demand from China, India, Russia, Brazil, in terms of investing in Africa, but also doing trade with Africa, I think that sets the scene for, or continues to set the scene for, a massive explosion in the opportunities in the financial services sector.
Of course, we see that's the view of one global player within the financial services space. So to what extent have investors been enticed into this space? Because it's easy enough seeing the appeal. How's that translating into actual investment?
Well, I think, to start with, the spin as we talk about this is just to think about what the potential is and to say we've come some way, but we are just beginning to touch the surface of it all. And if I take where I come from in Nigeria, with about 160 million people, and say to myself, how much of this is within the banking sector? How much of this is, it has been included in terms of formal banking? And it's really less than about 40 million people if we add up all the accounts we have in the banks in Nigeria. And that begins to tell you the potential. And I think that's the story that the foreign investors, some people understand and understand well, and have said to themselves, it's going to take, coming into Africa needs some learning. Every country is different. Every country has different issues. And there's a learning curve to it. So therefore, because there's a learning curve, and if I take this big potential in Africa, Nicholas mentioned, the study that was done by McKinsey that talks about the consumer power that we expect to see in 2012 and the cities we learned. Just taking Nigeria, we have cities in Ibadan and Kano that's expected that in terms of consumer power, we'll have about $100 million in another 15 years. So I think it's that story. And then saying to yourselves, this is the time that I need to invest. This is the time I need to learn. This is the time I need to make mistakes if I have to in coming into Africa, because every country is different. And this is the time I need to understand how to play in Africa, and especially in the financial service industry. What we found out is that some of the frameworks, because it needs a certain enabling infrastructure, those frameworks are not frameworks that you can import wholesale into Africa. So you need to sort of redefine some of the ways you play to be able to be successful.
Dave, it's going to sound, a bit of a basic strategy, but some say one lucrative strategy is to perhaps bet big on a big economy, a booming economy. We had Portugal's banks re-entering Angola after the civil war to enjoy, the cash in on that oil bonanza that's been happening. Is that a sensible move or just too daring in your books?
Let me translate that into what we're seeing. Invariably, given the size of the economies in Nigeria, in South Africa, and for us in Egypt as well, that's where a lot of our time and effort goes into, and looking for new opportunities. But I think what's happening is quite interesting in terms of those exciting businesses are now starting to take a much more regional view. And those for us really are the gems, those businesses that are now starting to build a truly regional-based African business. taking a national champion status and taking that success into other parts of West Africa, Central Africa, wherever it may be. So, we like the benefit of being able to play across the entire continent. And more specifically to your question, not relying on any one specific country in the continent to generate returns for our investors.
Nicholas, I mean, while it's all very enticing, just how easy is it setting up shop to leverage off the opportunity, off the potential that we've been highlighting right now? I mean, you've got quite an extensive footprint on the continent. What's been, let's say, the top 3 challenges of doing business in Africa?
I think Africa is an enigma for a lot of investors coming in. It's very big. There's a lot of the dynamics. We've spoken about the fundamentals, but it's broken up into a number of different geographies and countries. And there's a few economic groupings that are easier to do business in or that make more economic sense, and people can target those. However, the reality is one needs to almost have a tailored approach for each market in each country. So having the flexibility to tailor your investment strategy, say, for Kenya or Nigeria, they can be similar, but they need to be different because the realities of the markets in which one operates are different. And so global partners can be useful in many ways in terms of understanding how to get things done and being effective very, very quickly upon investing in the country. But one also needs to have local partners who have the knowledge on how to get things done, because that can be your differentiator in terms of just opening doors for you, understanding the fundamentals of how the country works, because there's a national psyche as well that also is at play. So I think it's difficult to paint Africa as in broad brushstrokes. It's easy, it's convenient. Unfortunately, I think people have done that often on a negative perspective. The reality is to get in and start to unpick the different markets. You've got to be able to tailor your approach.
Absolutely. Well, Junior, I mean, to mitigate against some of the challenges and risk, emphasis naturally gets placed on regulatory systems. We've had South Africa's banking system, for example, being relatively well shielded from the global economic crisis that's been unfolding, and that largely due to tight regulation, good governance, being well capitalized as well. Yet worldwide, we've got regulatory oversight that continues to be one of the top concerns that faces the financial services sector. I mean, is that warranted, given all the turmoil that's actually played out?
I think, in a way, it's well earned, the current wave of, one might want to call it over-regulation. I think it's for a good reason. We saw initially a swing towards extreme deregulation, and I think the pendulum is now swinging to the other extreme. That's what's happening at the global level. But on the continent, you did say that South Africa, for example, the banking sector, the insurance sector have been very well regulated. We didn't see any of that turmoil that is still playing out there. The rest of the continent, very similar to South Africa in that respect. We see in Francophone-speaking countries, for example, on the insurance side, they've got one insurance code that applies throughout all the countries in Francophone West Africa. That certainly makes it easy to transact business. They also have one currency. That makes it even double easy. And then you look at the former English colonies, the English-speaking part of Africa. The regulatory framework is very similar, as are the products that we sell in those markets. So there are those similarities that you see. One would also comment that with the expansion of international players into the various regions, you are seeing regulators becoming more cautious. And one might even venture to say a little bit protective in certain areas. But again, that is to be expected in this time of change.
Sorry, Nicholas.
I mean, one of my observations would be that a lot of the central banks, one of the benefits of globalization has been that people are more connected. So the governor of the central bank in Zambia has a discussion with the governor of the Reserve Bank in South Africa, and there's common themes that come out. So when you go and meet the governor of the central bank in Tanzania or Algeria, a lot of them are thinking along similar lines in terms of what they're trying to achieve, but also how to go about it. So that issues that surface in one country, the bank might be questioning you in a similar way in another part of the continent. So I think that connectivity is playing through. The central banks, their focus in many ways is quite consistent. I think they're looking at liquidity. to make sure that their markets have the liquidity to support whatever demands fall upon them. Clearly, protecting customer deposits is a key focus of any banking system. They're looking at protecting market risk, credit risk, and the operational risk component. So I think in terms of the frameworks, you've seen the evolution from Basel I to Basel II to Basel III now. Countries are differing levels of evolution there, but I think the rate at which they will catch up will probably start to shrink as people maybe leapfrog straight from a Basel I regime into a Basel III regime. And because of the globalization, the best practices can become implemented much faster, just as one has seen mobile banking, for example, and mobile telephony has leapfrogged landline. It's gone straight from nothing to 500 million cell phone users across Africa, which I think just shows at the rate at which people can adopt new technologies and thinking. It's difficult to predict how fast that's going to happen.
When it comes to central banks aligning themselves to global norms and global standards, Nigeria, case in point, Central Bank of Nigeria and Governor Sanusi cleaning things up in a very big way back in 2010.
Yeah, I think if there's one thing that's shaped the industry and is enabling the industry play a role in financial services and growth of the Nigerian economy, it really has been the regulator. And as you rightly said, if I take the Nigerian situation, and I think it's the Nigerian, starting with raising the capital that was done by Governor Soludo before Governor Sanusi. And what that did was that it resulted in a complete consolidation of the industry in Nigeria. We went from 89 banks to 23 banks. We then had banks that could begin to think of an international agenda, could begin to think of the shores outside Nigeria and say, how do I invest? How do I facilitate trade within Africa? How do I play a role in that? And we then ended up with bigger institutions, bigger banks, which obviously then was a different set of challenge when Governor Sanusi came in, because you then have bigger banks that are, you then have to focus on the stability of the sector itself, which is what he then did in terms of stability, in terms of governance, to ensure that we had the right governance in the industry. But what the increased capital has done is that it's actually made banks focus better on their role in terms of growth of the sector. So growth in two dimensions I've seen working with the banks. One is trying to grow the retail banking business, which is clear as you talk to every bank now that the future in Africa is the bank that can grow its retail business despite all the challenges we have. And, we're talking over lunch. I mean, one of the basic challenges we have is we don't have a national ID system. And it's difficult for you to grow the retail banking business and grow the credit if you don't have those things. But my view as we work is that it's a person who, despite all that, can find a solution that can work. And if we look at what the telecom sector has done in terms of growing, despite the infrastructural issues, despite not having power, despite, if you look at the telecom, they're the biggest generators of power in Nigeria, but, they're still able to have a very profitable business. I think those are some of the things that need to come into the financial industry to grow. And I think also one of the things, just to touch upon it, talking about the central bank's agenda that has been close to Governor Sanusi, is how do I intervene in critical sectors in the economy. So power is one, where he set up an intervention fund. Again, it's to ease credit into those critical areas where we need to invest in infrastructure. I think the jury is out in terms of how successful that would be.
Nicholas, on the flip side of tighter regulation, though, I mean, you've got to consider higher costs. You've got to consider management distractions, constraints on profitability, the capacity to lend as well. To what extent has tighter regulation influenced a change in Citibank's strategy or business model?
I think clearly the costs of compliance in the banking sector have increased. We've seen a number of different regulations come in. Basel per se, if one looks at the amount of capital that one has to hold against various asset classes, that has certainly driven that up, which my private equity colleagues would know that depresses your rate of return. So it starts to make people think differently about how they allocate capital. I think a couple of broad themes that are coming out as well is around the whole KYC or know your customer environment, just the level of diligence that's required and expected by regulators, so you understand who the beneficial owners of companies are, who your clients are. I think that's been evolving. South Africa's been doing KIC in terms of the Financial Intelligence Centre Act since about 2003, if my memory serves me correctly. Some countries are much more advanced in that. Other countries are still saying, why do you ask for this information? Other banks don't want it. So I think one of the things that I've seen is that as a part of a global bank, you're also driving market change, which is what it is. But I think certainly the regulatory requirements have gone up, and one has to be just much more, I think, thoughtful and considered in terms of how one goes about operating. Clearly, whenever there's a blowout in the global banking system and a bank loses a few billion on credit issues, or if there's an AML issue, I think those things have been pretty widely spoken about in the press. One just gets a sense the global focus and the globalization impact, again, is showing that if you want to play in banking, you need to be playing at a certain level, and possibly what will happen, you'll see more consolidation in the sector, particularly amongst Africa, is just the cost of running a banking license and complying with all these regulations is just starting to mount very, very rapidly. So, I guess in the smaller economies, you will see some consolidation going on there.
Dave, finding a strategy that works isn't easy, because while you have to have a plan, you've also got to be nimble enough to adapt as you go along. What's your sense of the evolution that we're seeing in terms of providing financial services in Africa for Africans? The fact that we're speaking to a reinsurer, a private equity player like yourself, it really speaks to a deepening of the financial services sector.
I think deepening is the right word, because as our economies in Africa have grown, there's an increasing demand for sophistication of financial services products. I think, completely agree with BC on the rollout of retail opportunity. We have made investments in the banking sector in different parts of the continent, particularly on this theme. Egypt is a good case in point. The opportunity to bring the right kind of tailored solution to the retail base in economies like Egypt and other African economies is fantastic. Getting it right, as you say, is not without its challenges. But there's a lot of rapid change going on in the financial services sector, right down at the consumer level. We've referenced it, the wave of telecoms growth over the last decade. But we're starting to find some really interesting opportunities in this crossover between how consumers are, if you will, consuming financial services products. The rise of debit cards, credit cards, is just tremendous. It's on the back of that we're trying to build out a business doing card issuance and payment processing for not just on a country basis, but of a banking platform right across the continent. So it's happening fast. And I sometimes feel that, how do you have to, the flexibility, the nimbleness, some of the competitive landscape in other parts of the world, I think have been through some of this change. I'm thinking about the Indian private sector. A lot of these businesses, whether it's financial services or other, they just get it. They get how to service customers in a more informal market environment. I think those are the sort of players that are potential challenges to business models of perhaps MNCs or if you will, more westernized developed market models.
Nicholas, perhaps a case in point, is the Equity Bank over in Kenya. It turned the traditional way of doing banking and catering to the mass market on its head, basically, targeting the unbanked and partnering specifically with technology via M-Pesa to get its grips on that consumer market.
Absolutely, and I think people have made some bold moves in that space. But I think what's also interesting is the different approaches that regulators have. So in Kenya, the regulator worked with the telco and with the bank, saying, okay, build the business and figure out how you're going to work, and then we'll determine how we're going to regulate you. And that, I think, is symptomatic of the East Africa running in terms of common law practices. So there's a lot of precedent in addition to the statute law. They've done it that way. Other places start to say, well, okay, here's your business, define the model, and we will draft regulations within which you operate. M-Pesa's got 16 million customers. Other places are really battling to come out the block. So the point is, there's different. It comes back to the point I made earlier about Africa is different. There's many different markets, but when you look at the rate of evolutionary change, Nigeria has done a fantastic job in terms of restructuring the banking sector, trying to put in place a national ID system. Why is that important? Because that talks to then how you can do KYC on customers. It links into credit bureau. There's a project to drive that. Nigeria is, Lagos State is trying to run a cashless Lagos environment, so trying to get cash out of the economy because of just the issues around managing cash. So in terms of doing a leapfrog from a lot of cash straight into a cashless environment, it's not a gradual evolution, and the government is really serious about actually doing that. So the rate of evolution is different across the different markets.
I was going to comment. I mean, and I think the interesting thing is that to succeed, the flexibility, that David's mentioned in terms of business models, and part of the difference we see is that if you took the global banks compared to the local banks, the cost of compliance is much higher for the global banks. There's still some regulatory arbitrage that can exist within Africa because of local standards and where the global standards are. And you may Douglas may agree or disagree. So you have a Citibank who's playing and has to play by the rules that you see in the US. You have Nigerian banks, the big Nigerian banks, the First Bank and the GTB, who are local banks who really don't have to comply with that, strict amount of regulation. And therefore, it enables them to be more flexible in terms of what they can do in the marketplace, more flexible in terms of the products they can develop, much flexible in terms of, I would say, the time to market, which is key, I think, in Africa and what has to be done. And just, talking about the mobile banking, and I think the interesting one, because it's very, as we talk about M-Pesa, is you'd say Nigeria is taking a completely different route, which is what we've touched on now, where M-Pesa, the telco companies were allowed to develop banking business, where our regulator said, look, I've looked ahead. There's no way I'm going to allow the telcos to own banking business because M-Pesa is banking business. So our central bank has gone ahead, defined a framework and said there are different models, but the models I'm going to allow in Nigeria is really a bank-led model. I want to be able to regulate, I want to be able to control the deposits, and that has its own challenges because as you define those different models, then there's a period where you need to shape how that's going to work exactly.
Yeah. Junior, just as we conclude this section of the conversation, I mean, we've had the G20 leading the drive to changing, banking regulation around the globe. What's your view on the changes that are being proposed, and what kind of impact you see it having on banking in the continent, mere access to capital?
Well, I would answer your question from what I see on the insurance side, because that's where I come from. But the principles are the same. Basel II, Basel III, we have our own Solvency II, which is being rolled out in Europe, in South Africa, and interestingly, a few countries on the continent are also talking of introducing Solvency II, which is a risk-based form of regulation. And I agree with the previous speaker. What we see is for your small player who's not very well diversified, or in terms of products or geography, the approach is punitive. They would need to increase capital. They will need to get more capital on board. But that has got its own benefits because it means they have to make better use of that capital. It also means they have to have discipline in their fundamental business, in our case, which is insurance. You have to price your products bearing in mind that you are carrying a big bag of capital behind you,
and
which needs to be rewarded.
steps your role as Munich.
Exactly,
we will be continuing this conversation straight after this short break. Of course, we'll be taking a few questions from our international audience that join us via webcast this afternoon, as well as from our live audience, so don't go away.